All right, we were at the tail end of this thing here where we left off. This third video is going to be rather short. We're down at D here. Remember, I did an entire lecture on T-bills and bonds. That's the day I drew the letters on my head, just so you understand this. Okay, now remember, my goal is to give you notes for you to have right in front of you, and I'm going to try to make them like 2 to 3 pages long so you can actually go there. This just seems like it's wrong, but they have stressed repeatedly you can use your notes in your textbook. And so, anyway, here's the deal. When the Federal Reserve purchased bonds, I'm going to give you the long version and the short version. So, think about this. When the Federal Reserve purchased bonds, okay, what will happen to the price of bonds in the open market? Now, if you remember my lecture, I told you they no longer say price of bonds anymore. They now say price of previously issued bonds. So let's say the year before you bought a bond and it was at 5% interest. Now the Federal Reserve is buying T-bills. What are they doing with the money supply? They're pumping it up, right? They're pushing money out there, okay? So they're buying T-bills. If they're pushing money out there, the money supply is going up. So we got this old bond at 5% interest. If the money supply is going up, what are the banks going to have to do with interest? What's going to happen to interest in the United States? The more money you have, what's going to happen to interest? Remember, there's an inverse relationship. Interest is going to go down. So this year, when not the Federal Reserve, but when the U.S. Treasury, remember, they're two different things. When they sell T-bills, let's say they sell them at 4%. Okay. Well, what would you rather have? A $5,000 T-bill paying 5% or one paying 4%? You'd rather have the one paying 5%, but now the price is gonna go up because of the higher interest rate. So the short answer is they will go up. Again, if you don't remember this, you got a 50-50 shot. But the answer is they go up. And here's your description: says as Fed buys T-bills, the nominal interest rate goes down, making older bonds with higher interest rates worth more. Okay. And lastly, boy, I hope you don't even need to think about this. We've done what? 1, 2, 3. We've done 5 of these in a row. You should be wise. They're going to ask you this. Suppose that instead of the purchase of bonds by the Federal Reserve, an individual deposits $5,000 in cash into her checking. Look here, they gave you both names for it: checking account and demand deposit. What is the immediate effect of the cash deposit on the M1 measure of the money supply? There is no effect. Okay, so make sure you write up there's no change in the money supply. Okay, we are now done with my part. I'm going to go on to the next 2 slides. And what I want you to do now in your notes, when you send these to me, you've written down all the answers. The next 2 I want you to do on your own. Unless you are really cocky or you really don't like talking to other people, what I would like for you to do, if you have first or second semester friends, it doesn't matter. I would imagine second semester would be more help. What I'd like for you to do is try the problems on your own and then check with your buddies, okay? Because as you're about to find out in a few minutes, I guess you will have already heard this before you see this video. The grades on last Friday's essays were not very good. So I think a lot of you probably didn't do what I asked you to do. You probably didn't call anybody else. And I understand if you want to do the work on your own. But so whatever, does it matter? You can do it on your own and call your friend. But I'm telling you, calling a couple friends and hearing them explain it would be wise. Okay, here's the homework. And it's not going to be an extra page. It's going to go on the bottom. Okay. So just put on your paper, label it homework number 1. Okay. And let me just tell you, it would probably be very wise for you to draw this chart down. We did spend a couple days on banking balance sheets. I put a lot of time into this. And you remember, if you've got this little chart in front of you, both sides have to have the same total at the bottom. Okay. Anyway, you can pause this at whatever point you want. You don't have to write the questions. You just have to answer them. Just call it homework problem number 1. Okay. And answer this. But I'm just telling you, it would be very good for you to draw this here so you can cross it out and make corrections. Okay. There's problem number 1. And here is problem number 2. Now, I know I did this one in class, but hopefully you don't remember. Anyway, do both of these. And what you need to do is send this page to me, your classwork assignment, either Monday night or Tuesday morning. We're going to have a same time as usual, 11 o'clock. We're going to have our essays Tuesday on the bank and balance sheet. And I'll throw the bonds thing in too. So these are very good practice. I may even take one of these and just change the numbers around. Okay. All right. End of the video.